Today's video starts with something that might seem technical, almost bureaucratic at first glance, but it is setting off alarms in strategic circles across the West. I'm talking about the rapid acceleration of China's strategic stockpiling of oil, gas, food, and critical metals. On the surface, it could look like prudent management. A large country, heavily dependent on imports, organizing its reserves. But when you look at the numbers, when you examine satellite imagery, and when you connect the geopolitical context, the movement takes on a very different meaning. If you look at some of China's largest oil storage facilities along its coastline, what you see is staggering. Massive circular tanks stretching across the landscape, almost like giant baking molds seen from space. As these tanks fill, their floating roofs slowly rise, transforming flat surfaces into enormous metallic domes. And recently, those roofs have been rising quickly. China has been adding millions of barrels to its visible reserves in a matter of weeks. Complexes that were built only a few years ago are already nearing half capacity, and more facilities are still under construction. But oil is just the visible part of a much broader strategy. Behind those tanks lies a comprehensive effort that combines energy security, food reserves, critical minerals, and global logistics positioning. The question many analysts are now asking is simple. Why now? Why accelerate accumulation at this pace? And why does this urgency coincide with rising geopolitical tensions? Since early 2024, when it became increasingly clear that U.S.-China tensions could intensify again, Chinese authorities began systematically expanding reserves. Tariffs, sanctions, financial restrictions, technological export controls. All of these factors entered Beijing's strategic calculations. The logic is straightforward. The greater the uncertainty abroad, the stronger the need for insulation at home. Some observers interpret this buildup as paranoia. Others see it as preparation for a possible Taiwan scenario. In certain strategic circles in Asia, there is a widely held belief that energy and food stockpile levels are indirect indicators of readiness. Stockpiling does not automatically mean war, but insufficient stockpiles would make any large-scale confrontation unsustainable. Regardless of the ultimate motive, the result is the same. China is actively reducing its vulnerability. The country consumes roughly 16 million barrels of oil per day, and approximately three-quarters of that is imported. Any maritime disruption would have immediate consequences. Choke points like the Strait of Malacca are viewed in Beijing as strategic pressure points. In the event of a naval blockade, the economic impact would be immediate and severe. The same applies to natural gas, whose consumption has surged over the past decade, driven by urban heating demand and chemical production. Coal, still responsible for a significant portion of China's electricity generation, continues to be imported in enormous quantities. Energy remains the backbone of industrial power. Without energy, factories stop. When factories stop, global supply chains begin to fracture. But China's vulnerability does not stop with energy. The country imports the vast majority of the iron ore used in steel production. It depends on foreign suppliers for copper, bauxite, cobalt, nickel, critical materials for batteries, power grids, and advanced manufacturing. At the same time, rising income levels and dietary shifts have dramatically increased demand for imported agricultural goods. Soybeans in particular are essential for feeding hundreds of millions of pigs that support China's protein consumption. When you combine energy dependence, mineral imports, and food reliance, the picture becomes clear. The so-called factory of the world runs on external inputs at a massive scale. From Beijing's perspective, that dependence is not just an economic issue, it is a national security vulnerability. To manage this exposure, China appears to be pulling three major strategic levers. The first is expanding domestic production. Through tax incentives and investment programs, state-owned energy companies have been pushed to increase oil and gas output, even defying earlier predictions of structural decline. Domestic production does not eliminate dependence, but it creates strategic breathing room. It also reinforces state-controlled enterprises as direct instruments of national policy. The second lever is the expansion of reserves themselves. Visible strategic petroleum reserves have grown significantly, And there are strong indications that non-transparent stockpiling of metals is also underway. The opacity itself is strategic. If competitors do not know how much is being accumulated, they cannot easily anticipate demand shifts or coordinate countermeasures. The third lever is diversification. China has deepened energy purchases from Russia, Iran, and Venezuela, countries facing Western sanctions. By doing so, Beijing often secures discounted prices, strengthens political partnerships, and experiments with financial settlement systems that bypass the US dollar. At the same time, it has expanded agreements with Middle Eastern and Central Asian suppliers. But diversification is not neutral. It often replaces one dependency with another. Greater reliance on Russian pipeline gas creates new political interdependence. Reduced exposure to U.S. soybeans increases reliance on Brazilian harvests, which are vulnerable to climate events and domestic political shifts. In attempting to reduce strategic risk, China inevitably assumes new forms of exposure. This stockpiling campaign is also reshaping global commodity markets. Farmers adjust planting decisions in response to Chinese demand. Ports and rail networks are financed with Chinese capital. Mining operations become tied to long-term supply agreements. Infrastructure investments abroad serve both commercial and geopolitical functions, creating enduring economic influence. Yet this strategy comes with costs. Stockpiling oil at elevated prices risks financial losses if prices fall. Accumulating metals beyond immediate industrial needs ties up capital. Paying premiums for preferred suppliers may reduce short-term efficiency. From a purely financial perspective, parts of this strategy resemble an expensive insurance policy. But geopolitics rarely operates on short-term efficiency alone. States prioritize resilience and survivability. For Beijing, reducing vulnerability to external pressure may justify substantial financial trade-offs. Strategic security, in this view, outweighs short-term market optimization. So the real question may not be whether China is preparing for war. The deeper question is whether China is preparing for a world in which economic, technological, and potentially military confrontation is increasingly plausible. Building reserves buys time, time to negotiate, time to absorb shocks, time to withstand coercion. By attempting to shield itself from sanctions and external pressure, China strengthens its bargaining position, but it also ties itself more tightly to certain partners and assumes new financial and political risks. If global conditions stabilize, these reserves may appear excessive and costly. If global tensions escalate, they may prove decisive. Ultimately, what we are witnessing is not merely oil storage. It is the reemergence of strategic stockpiling as a central pillar of great power competition. In an era once defined by deep interdependence, supply chains are increasingly viewed through the lens of security and leverage. And that may be the most important signal of all. China is not simply buying commodities, it is buying resilience. Whether that resilience is meant for negotiation, deterrence, or something more serious remains the question.